Hello friends, thank you for tuning in to our channel. In this video, we will be talking briefly about assets. Welcome to our channel, and for all those first-timers, this is little as 5 minutes, your one-stop destination to learn a new lesson in just less than 5 minutes. Asset is a resource owned, controlled by an entity as a result of past transactions and from which monetary benefits are expected to flow to the entity in the future. They are not meant for resale. Assets are further categorized into the following classifications: current assets and non-current or fixed assets. Current assets are cash and other assets that are expected to be converted into cash, consumed or sold within 1 year or in the operating cycle, whichever is longer. These assets are continually converted into cash during the course of normal business activity. There are 5 major assets included in the definition of current assets. 1. Cash and cash equivalents. Cash includes money that a business entity holds and money deposited in other institutions that can be quickly withdrawn without notice. Cash equivalents consists of highly liquid, short-term investments that can be readily converted to known amounts of cash and are so close to maturity date when they were acquired by the entity, 90 days or less from date of purchase, that they present negligible risk due to changes in value on account of changes in interest rates. Examples include treasury bills, commercial paper, certificates of deposits (CDs), and money market fund. 2. Receivables. It is the money owed by customers in exchange for services or goods that have been delivered or consumed, but not yet paid for. It will be usually reported as net of allowance for uncollectible accounts. 3. Short-term investments. Short-term investments include securities bought and held for sale in the near future in order to realize profits on account of short-term price differences, trading securities. 4. Prepaid expenses. These are assets that arise as a result of making advance payments for goods or services expected to be received in future. They are reported as assets, but the value of these assets will be expensed over a period of time based on the receipt of benefit for which the advance payment was made. As they get expensed, the corresponding expense is reported in the income statement. For example, a company had a 1-year fire insurance policy cost of $24,000. As each month elapses, $2,000 of prepaid fire insurance would be expensed to income statement until the amount paid gets fully exhausted. 5. Closing stock. Closing stocks are the goods purchased or manufactured but not sold till the end of accounting period. Now, let's understand what does non-current assets means. Non-current assets are assets which are not expected to be converted to cash, sold, or consumed within a year. Fixed assets, accumulated depreciation, intangible assets and long-term investments are included in the definition of non-current assets. Let's learn some of these non-assets in little more detail. 1. Fixed asset. Fixed assets are tangible assets used in productive capacity, and the benefits accrued from use of these assets are expected to last for more than 1 year. Fixed assets normally include assets such as land, buildings, plant and machinery, vehicles, furniture and office equipment. 2. Accumulated depreciation. The depreciation charged on depreciable assets from the date of purchase till the reporting date are termed as accumulated depreciation. 3. Intangible assets. Intangible assets are those assets which provide future economic benefit but doesn't have physical substance, i.e., cannot be seen or touched. They include patents, copyrights, goodwill, trademarks, trade names, etc. These assets can be classified into 2 categories: indefinite life and definite life. A company brand name will not have a definite lifespan and stays with the company as long as the company is in existence. However, if a company signs a legal contract to use another company's patent for a certain number of years, then the patent would have a limited life and is treated accordingly in the books of accounts as a definite asset. 4. Long-term investments. Long-term investments are to be held for several years and are not intended to be sold or disposed of in the near future. e.g., investment in pension funds or investment in subsidiary companies. Let us know how you find this lesson. Was there anything you already knew? Did you find this useful? Do you have any related information you would like to share? Leave it in the comments below, we love hearing from you. And if you liked our video, don't forget to give it a thumbs up and share it with your friends. Hit subscribe and ring the bell right now to stay updated on more such little interesting lessons that will matter the most. Stay tuned.